Welcome to the Deep Dive, the place where we turn complex, dense research into quickly consumable, high-value knowledge. Today, we are taking a massive deep plunge into the rail sector, specifically boarding a freight train with Canadian National Railway, or CNR.
Yeah, and this dive is absolutely timely, crucial, really, because we're looking at one half of the North American rail duopoly, the other being Canadian Pacific, of course. But CNR, they're currently facing this fascinating, almost paradoxical situation. I mean, they are a core structural pillar of North American trade infrastructure, arguably one of the best assets in the world.
Right, essential.
Totally essential. Yet their recent performance, well, it's been marred by pretty significant operational challenges throughout fiscal year 2024. And now, as they head into 2025, they're running headlong into some severe macroeconomic headwinds. We're talking volatile global tariffs, unfavorable currency swings. It's a lot.
Okay, so our mission today is complex but clear. We've got a robust stack of recent sources detailed FY24 and Q2 2025 earnings reports. And interestingly, two wildly divergent investment analyses. One's pretty bullish on their long-term moat, their competitive advantage. The other, highly skeptical of their financial structure.
Exactly.
So we need to cut through the jargon, the noise, pull out those critical financial nuggets, and really try to determine CNR's true, sustainable health. We're specifically looking to see if their recent operational fixes, are they evidence of true long-term resilience? Or maybe just short-term bandages, masking deeper structural issues, especially around capital allocation.
Yeah, it's the ultimate test, isn't it? Intrinsic value versus cyclical volatility. We have to separate the temporary slowdowns, which, hit every cyclical business, from the core decisions management has made about their balance sheet. Essentially, we need to figure out if the track they're laying down is built to last, or if they're just, painting over the rust to keep the trains moving for now.
Okay, let's unpack this immediately then. Starting with the immediate past CNR's 2024 fiscal year. You said messy. The sources use phrases like little to be proud of. What were the headline numbers that really illustrate the level of disruption they were dealing with?
Well, the FY24 results were certainly mixed, but that operational strain was unmistakable. Look at revenues they managed a marginal climb, only up 1%. But the core pain point was translating that tiny bit of growth into profit.
Right, the bottom line.
Exactly. Earnings per share, EPS, which is what shareholders really watch, it decreased by a substantial 18% compared to the prior year. Even if you adjust for one-off items, the adjusted EPS still showed a 2% decline. Now, in the context of a regulated duopoly, where stability is usually the name of the game, an 18% drop, that's a major signal of distress.
And this wasn't just like bad management or demand suddenly drying up. Management pointed to specific high-impact events, didn't they? Can you elaborate on those operational headwinds?
Absolutely. The strain was largely pinned on significant, non-recurring, sort of one-off challenges that directly hit their network throughput. We're talking major labor disputes that literally halted operations, severe, prolonged port strikes on key trade routes, and then, mandated rail shutdowns due to weather or accidents. These things are just catastrophic for a logistics business where everything relies on high-speed, predictable scheduling. When the network seizes up like that, the domino effect on costs is immediate and painful.
So when a network faces that kind of internal chaos, how do we as analysts actually measure its physical health? Is there a key real metric that tells that story?
Yeah, the top measure for network efficiency and speed is car velocity. It's usually measured in car miles per day. Basically, it tells you how quickly, on average, a piece of cargo is actually moving through the system.
Huh.
In FY24, this indicator was demonstrably lower than the prior year. It directly reflected those persistent operational hiccups from the strikes and shutdowns.
Slower network.
Definitely slower. However, in their defense, management argued it was still adequate considering the severe obstacles they faced. The network was slower, yes, but it didn't completely collapse, which I suppose speaks to their underlying operational structure.
Okay, that's the operational side. Let's shift to the balance sheet, the financial stability. In a period of operational chaos, the balance sheet should ideally act as a shock absorber, right? How did the key financial metrics hold up under this dual strain of low growth and high disruption?
Right, and this is where we start to see some structural issues maybe emerging, particularly related to leverage. Almost every critical financial metric worsened in FY24. The net profit margin, which tells us how efficiently they turn revenue into profit, it fell significantly to 26%. But for investors focused on long-term risk, the movement in leverage was probably the most concerning part. Long-term debt increased, pushing the long-term debt-to-equity ratio up to a pretty noticeable 0.94.
Okay, 0.94. Now, that sounds high compared to maybe a typical industrial company, but rail is super capital intensive. Is that figure really alarming for this industry?
Well, it certainly raises an eyebrow when you look at the context. I mean, for a regulated rail duopoly that enjoys fairly predictable cash flows, some leverage is expected, even optimized. However, a ratio getting close to 1.0 suggests a heavy reliance on borrowed money relative to shareholder equity. What makes it concerning is the speed of that increase, which we'll definitely get into more in Section 2. It kind of indicates an aggressive capital allocation strategy, maybe focusing more on debt than strictly organic growth.
Right. And speaking of cash, they're an infrastructure giant, so there should be cash flow machines. How did their cash generation actually stack up against those debt obligations?
Oh, they generated substantial cash, no doubt. Operating cash flow, OCF, was reported at $6.7 billion. After you factor in their mandatory capital expenditures, the money needed just to keep the rails and bridges maintained, they netted approximately $3.1 billion in free cash flow, FCF.
Okay, $3.1 billion in free cash. That sounds pretty good.
Yeah.
But how does that compare to that rising debt load you mentioned?
Yeah, that's the key comparison. When you look at that FCF relative to their long-term debt, the ratio of FCF to debt was only 0.15. Now, to put that 0.15 in perspective, a lot of infrastructure analysts, long-term investors, they like to see a ratio closer to 0.25, maybe even higher. That signals comfortable deleveraging potential, the ability to pay down debt relatively quickly.
So 0.15 is low then?
It's quite low. It means that the cash they generate after all the necessary maintenance capital expenditure, the sustaining Capex, it would take almost 7 years just to pay off the current debt stack. And that's assuming zero growth in FCF. That's a heavy, 7-year commitment for a business that is, at its heart, cyclical.
And despite that earnings pressure and the low FCF to debt ratio, they still managed to prioritize shareholder returns, didn't they? Dividends and buybacks.
They definitely maintained an aggressive stance on shareholder returns. Dividends per share, DPS, increased by 7%. But because the underlying net income was under strain, this increase pushed the dividend payout ratio up to 48%.
48%.
Yeah, and that's a critical indicator. It actually exceeds the payout high they saw even during the really disruptive 2020 pandemic year, which was 46%. So while the consistent decrease in outstanding shares due to the buyback program was, technically positive for the EPS calculation.
Right, fewer shares means higher earnings per share.
Exactly. But that rising payout ratio signals real strain in maintaining dividend growth without corresponding organic earnings growth backing it up. And that rising payout ratio in a low growth year, it's the perfect segue, really, because here's where we move from those sort of tactical operational problems of 2024 to a deeper, more structural critique that one of our investment sources raises. They argue that CNR's reported EPS growth over the last, say, 5 to 7 years hasn't been driven by robust organic business expansion. Instead, it's been heavily focused on financial maneuvers. They actually frame this as financial engineering.
Okay, financial engineering. That's a loaded term, isn't it? I mean, isn't aggressive debt financing sometimes a smart move, especially when interest rates were low and the asset is essential, long-lived infrastructure like a railroad? Why do these critics frame CNR's strategy as problematic instead of just, smart capital allocation?
Well, it becomes problematic, or at least questionable, when the capital allocation specifically, the doubling of debt, doesn't translate into proportional business growth. The critique centers on this strategy of leveraging up the balance sheet primarily to fund massive share repurchase programs, which in turn, mechanically, almost artificially, inflates the EPS number.
Let's break down the numbers that support this skeptical view. How drastic was this shift? The balance sheet versus the core business output.
The shift was pretty stark, according to this analysis. Over the long term, we're looking at CNR's long-term debt essentially doubled. It soared from approximately $10 billion to roughly $20 billion. Now, logically, if you take on an extra $10 billion in debt and reinvest it efficiently in high-return growth projects like new track, new intermodal facilities, gaining new market share, you'd expect net income to track upward significantly and maybe even double over time as well.
Makes sense. More investment, more profit.
Right. But that simply did not happen here. Over the same period, net income remained largely stable. It hovered around the $5 billion mark, give or take, fluctuating with the usual business cycle.
Okay, wait. So the company took on $10 billion in new liability, but the actual total profits generated by the entire business didn't materially increase. Where did that massive influx of borrowed cash actually go, if not into expanding the business itself?
Well, according to the critique, it went directly into shrinking the denominator of the EPS equation through massive share buybacks. The company spent roughly $10 billion on these buybacks, concentrated heavily in 2022 and 2023. And this was done at pretty elevated stock prices, fueled by that post-pandemic economic exuberance, you remember?
They do.
So, by aggressively reducing the share count using borrowed money, they drive up earnings per share, even if the total net earnings, the numerator, remains stubbornly flat. This is the exact maneuver the critic explicitly called pure financial engineering.
Okay, I get the mechanism. Buyback shares, EPS goes up even if profits don't. But what's the immediate danger of this debt-fueled growth if the underlying business-moving freight remains pretty stable?
The risk is primarily twofold, and both revolve around the idea of reversion, things snapping back. First, the benefits of those massive aggressive buybacks, which were reflected in a much higher stock price during that period, they start to revert or disappear when the buyback program inevitably slows down or stops, which we've seen happen. Once that artificial scarcity of shares is removed, the market eventually has to refocus on the flat organic net income reality.
Okay, so the buyback boost fades. What's the second risk?
The second risk is the debt itself. That $10 billion in accumulated additional debt, it remains on the books, regardless of whether the economy is booming or contracting. So if we hit that severe economic downturn that many macro analysts are still worried about, a period when a cyclical business like CNR sees revenues drop dramatically, well, that debt burden and the resulting interest payments can revert the benefits of the buybacks entirely. The debt pile becomes this heavy liability, forcing capital to service debt instead of investing in future growth or even rewarding shareholders through dividends.
Right. And this all leads to a crucial point about valuation. If you filter out the EPS boost from the buybacks and you factor in the real cost of that debt, the price tag of the stock must change, right? That source suggested the real PE ratio is maybe closer to 27, not the reported 18. How do they justify such a massive difference?
Yeah, this is probably the most crucial part of the skeptical analysis. They argued that the reported PE of 18 is potentially misleading because standard net income calculations often don't fully capture the true cost of maintaining a massive physical asset like a railroad. A railroad requires a tremendous amount of capital expenditure just to keep things operating.
You mean like track renewal, bridge repair, locomotive
Right.
overhauls,
Hmm?
stuff that doesn't add new business but stops things from falling apart?
Exactly. We need to distinguish between growth Capex, which is discretionary spending on new lines or facilities that should generate more revenue, and sustaining Capex. Sustaining Capex is mandatory spending just to keep the current asset functional. It's the cost of staying in business. The skeptical analyst argues that if you properly account for the true cost of this, sustaining Capex treating it more like an ongoing operating expense, the company's real free cash flow, and thus its real earnings power, is far lower than what's typically reported.
Okay.
By that more aggressive, maybe more realistic calculation, the PE ratio jumps from that reported 18 all the way up to 27. This suggests a stock could be significantly overvalued based on its true organic, maintainable cash generation capability once you factor in the cost of just keeping the wheels on the track, so to speak.
Okay, let's shift gears now from the internal debate about debt and engineering to the external environment. Fiscal 2024 was messy, mainly due to internal disruptions like strikes. Fiscal 2025 seems dominated by external geopolitical and economic risks, tariffs, potential recession, currency swings. Let's start with the tariffs. How did CNR initially plan to handle these trade policy threats, and how dramatically did that outlook change by the time they reported their Q2 2025 results?
Right. Well, management began 2025 with a degree of, let's say, cautious confidence. They were forecasting some positive momentum in North American industrial production, relatively robust consumer demand. On the tariff front, which, involves a lot of speculation about future U.S. trade policy, they initially assumed the effects would not be severe or long-lasting enough to trigger a recession in Canada or cause significant inflation in the U.S. They planned for agility, sure, but the base case was more towards stability.
But trade policy is incredibly volatile, always shifting. What did the Q2 2025 update, the one reported in July, confirm about the reality of tariffs hitting their supply chain?
Yeah, the Q2 report was kind of a harsh dose of reality on that front. It confirmed that a noticeable tariff impact had definitely emerged, and it was now fundamentally influencing their growth agenda. The persistent, unpredictable uncertainty caused by these shifting U.S. tariff policies, it's now the central headwind affecting their North American supply chains. The tariffs aren't just some abstract threat anymore. They are concrete factors impacting actual production forecasts and freight flows.
Which sectors specifically felt this pain most directly? Where did it show up immediately in their Q2 volume reports?
Well, tariffs directly impact manufacturing and materials flows, so they hit key merchandise categories pretty hard. This was particularly visible in automotive. Automotive saw a 6% revenue decrease in Q2 2025, and that was directly linked to manufacturing uncertainty related to trade barriers. We also saw significant softness in forest products, which dropped 9%. That was exacerbated not just by potential tariffs, but also by ongoing weak market fundamentals and those existing punitive U.S. trade measures on lumber.
Right, the softwood lumber dispute never really goes away.
Exactly. And this broad uncertainty is now weighing heavily on their overall merchandise and intermodal volumes. It actually forced them to lower their full-year revenue ton miles, or RTM, growth assumption.
Okay, tariffs are a big headache.
Mhm.
Let's turn to currency, the FX rate. Rail is inherently a cross-border business. The Canadian dollar's movement against the US dollar must be a constant factor, maybe even a headache, especially given their debt structure.
Oh, it's a critical complexity, absolutely. CNR carries a large amount of its long-term debt in USD-denominated instruments. The reported debt sensitivity is roughly a 2-cent impact on their total debt for every single 1-cent change in the KUSD exchange rate. Earlier in 2025, when the Canadian dollar was weaker, hovering down your 70-cent SAD per USD, management actually saw this as a potential financial tailwind.
A weak Canadian dollar helps them. How? If their debt is in USD, that seems counterintuitive.
It's all about the earnings conversion. They earn a significant chunk of their revenue in US dollars from their extensive American network, right? So when they convert those strong USD earnings back into Canadian dollars for reporting purposes, a weak loonie generates a favorable exchange rate boost. It becomes a tailwind on the reported earnings. Earlier in the year, this was projected to be worth about $0.15 on their annual EPS. A nice little boost.
Ah, okay. So weaker CAD makes U.S. revenue look better in CAD reporting. But the twist is that outlook changed by Q2 2025.
Exactly. By July, the FX assumption had fundamentally flipped. Management now projected a strengthening CAD, anticipating a range of $0.70 to 75 cents for the rest of 2025. This strengthening currency means that every dollar of U.S. revenue they convert back into CAD now yields less, which is why management explicitly noted that this revised strengthening FX assumption is now further pressuring the earnings outlook. So they lost that hoped-for tailwind and are now dealing with a potential headwind, compounding the tariff risks. Not ideal, but while that external macroeconomic landscape deteriorated pretty rapidly, Q2 2025 is actually a story of strong internal execution. Moving into the second quarter, CNR clearly recognized the volume environment was going to be tough, and they executed a pivot, focusing heavily on operational efficiency and really aggressive cost control. There's a tremendous sense of urgency.
Okay, so the ultimate question for the operations team then is, did that pivot actually manage to protect the bottom line, despite the lower volumes and total revenues we just talked about?
They delivered, frankly, a textbook example of operational resilience under pressure. They achieved 2% adjusted diluted EPS growth. Now think about that 2% growth, even with a 1% decrease in total revenues and RTMs. The key driver here wasn't finding new business, it was just ironclad cost management, which effectively offset that revenue decline. This really shows the strength of that regulated rail duopoly model when it's managed correctly with PSR discipline.
A 5% decrease in expenses is pretty significant. Where exactly did those costs come out? Was it mostly just lower fuel prices, or were they actually cutting deep into operations?
It was a combination, definitely, but the strong cost takeout measures were absolutely central. Expenses decreased by that sizable 5%. Yes, partly due to lower fuel expenses, which are volatile and market-driven anyway, but critically, also due to decisive management action. This included lowering the company headcount, aligning staffing resources with the softer demand environment. They were managing costs surgically, it seems, matching capacity precisely to those lower than expected volumes.
And that focus on cost containment, that should be immediately reflected in the operating ratio, right, which you said is the key measure of efficiency for rails, the gold standard. Can you remind us what it is and what the improvement signaled?
Yep, the operating ratio, or OR, it's simply the percentage of revenue that gets consumed by expenses. Lower is always better. In Q2 2025, this aggressive cost alignment resulted in a 50 basis point improvement year over year. That delivered an adjusted OR of 61.7%. Now, to put that in context, In the world of rail and precision scheduled railroading, PSR, every 10 basis points of OR improvement is considered a major operational victory, like a hard-fought battle won against unit costs. So delivering 50 basis points suggests management isn't just cutting costs randomly, they're executing that PSR discipline effectively, aligning the network capacity almost perfectly with those lower traffic volumes.
Okay, so they pulled the cost levers effectively. But beyond costs, what do the hard operational metrics tell us about the actual fluidity of the network? Did they sacrifice service quality to achieve those cost cuts?
That's always the risk, isn't it? But the operational metrics actually showed across-the-board improvement, which is pretty strong evidence that their cost cuts were strategic, not detrimental to service. The network actually became more fluid. Car velocity, our measure of speed, it increased from 210 to 213 car miles per day, faster. Through dwell, that's the time a car spends just sitting idle in a yard, which is pure inefficiency, it decreased slightly from 6.9 to 6.8 hours. That indicates faster yard classification times, better network flow.
Less waiting around.
Good.
And the service commitment, the quality of delivery to customers.
That improved too. The local service commitment, which is the percentage of cars completing their daily scheduled plan, it ticked up from 94% to 95%. Small, but positive. More importantly, maybe, the efficiency gains showed real management discipline. We saw an impressive 11% increase in GTMs per train and inter-employee productivity. GTMs are gross ton miles. That shows they're getting much more output from a reduced, highly skilled workforce. They also achieved a 7% increase in tie installation efficiency, demonstrating improved engineering productivity and lower unit costs for that mandatory maintenance work.
Okay, impressive on the operational side. Now, looking at their market performance in Q2, that small 1% overall revenue decrease must mask some pretty serious internal shifts between cargo types, right? Where do they find the strength and where are the biggest drops?
Absolutely. The report mentioned a meaningful shift in traffic mix. The revenue strength came squarely from bulk movements. These are typically less affected by immediate economic volatility compared to consumer-facing goods. Specifically, grain and fertilizers saw a strong 12% revenue variance increase compared to Q2 2024, benefiting from strong agricultural exports. Coal revenues remained flat, which provided some essential stability.
Okay, so bulk, especially grain, carried the day. But what offset that strength to keep the total revenue slightly down?
Well, that strong bulk performance was pretty much wiped out by significant weakness in the more economically sensitive merchandise categories. We already noted the pain in automotive, negative 6%, and forest products, minus 9%. But metals and minerals also fell by 7%. And intermodal, that's the container business, a key measure of consumer spending and international trade health, it was down 3% overall. Interestingly, lower international intermodal volumes driven by blank sailings from Asia due to weaker global demand completely offset the domestic intermodal growth they did manage to achieve. So a real mixed bag within intermodal itself. So stepping back, it's really essential to remember that despite all this short-term volatility, despite the financial engineering critique, despite the tariff pressure, the sources unanimously remind us of CNR's deep structural advantages. These are the things that underpin its long-term value proposition.
Okay, let's focus on that bull case then. What makes CNR a potential top pick for long-term investors, even if they have these temporary stumbles? What are the core, maybe immutable advantages of this business?
Yeah, there are three main structural pillars that really define the bull case, and they're essential for understanding why some analysts still expect, say, 10% future earnings growth despite the current headwinds. First, they cite operational excellence. CNR is often held up as a global leader in mastering precision scheduled railroading, PSR. This discipline allows them to consistently achieve lower operating ratios and provide highly reliable performance, which is a huge differentiator when securing long-term contracts with shippers.
Right, PSR is key. The second point is often called their greatest moat, their strategic geographic footprint. This is more than just having a lot of track. It's where that track goes, isn't it?
Absolutely. The strategic geographic footprint is arguably their most enduring advantage. CNR boasts extensive networks in both Eastern and Western Canada, obviously, but the absolute key is their unique access to the lucrative U.S. markets. They offer the only single-line rail service connecting the Pacific Coast, the Atlantic Coast, and the Gulf Coast. Think about that. A container arriving in Vancouver can move on one single rail line all the way down to New Orleans or maybe over to Chicago without having to change hands, without incurring interchange costs with a competitor. This built-in resilience and superior capacity for transcontinental trade drastically reduces regulatory friction and operational complexity. It's huge.
Wow, that seamless access to the U.S. Midwest and the Gulf Coast must be invaluable for shipping commodities, manufactured goods, pretty much anything globally.
It's like the ultimate insurance policy for them. If volumes are soft on the West Coast due to, say, issues in Asia, they can pivot more easily to the East Coast ports or focus on the North-South trade via the Gulf. This geographic breadth and single-line service is something the competition, even CP after its merger, cannot fully replicate in the same seamless fashion. It makes CNR an absolutely essential structural component of North American supply chains.
Okay, operational excellence, unmatched geography. What's the third pillar? It touches on something critical in today's investment landscape: managing non-financial long-term risks.
That would be sustainability leadership. Their ongoing investments in cleaner, more fuel-efficient locomotives, their various fuel efficiency programs, and their transparent ESG reporting, environmental, social governance, are viewed as actively mitigating long-term climate and regulatory risks. For example, increased fuel efficiency directly combats fuel cost volatility, which is a huge expense for rails. And transparent ESG reporting ensures they can continue to access capital from increasingly ESG-focused institutional investors. It's just smart business, really, that also mitigates risks maybe 10 or 20 years down the line.
Okay, so given all that, the Q2 execution, the long-term strengths, but also the heightened macro risks, how did management officially adjust their expectations of the future? What did they signal to the market?
They signaled extreme caution, primarily due to those external factors. In light of the Q2 results and that heightened risk environment especially, the persistent tariff uncertainty and that strengthening FX pressure management took a highly significant step. They formally removed their entire long-term 2024-2026 financial outlook. Just pulled it. They simply felt they couldn't stand behind those multi-year goals anymore, given the level of external uncertainty.
Wow, scrapping the multi-year forecast entirely. That's a powerful signal in itself. What did they provide for the immediate future then, just for 2025?
For 2025, they immediately revised their adjusted diluted EPS guidance down. The new expected growth range is now in the mid-single-digit to high-single-digit range, so still growth, but significantly lower than previously hoped. And to protect these revised lower margins, they plan to continue the share repurchase program, keep supporting the stock price that way, but they're also tightening the belt further by reducing the capital plan by approximately $50 million from the initial $3.4 billion plan. It's a classic defensive playbook, really. Focus hard on cost discipline, protect existing shareholders through buybacks, and reduce non-essential capital spending until a fog of uncertainty starts to clear. And, this brings us back to the human element, doesn't it? The essential nature of this business means that these tracks, these trains, they're not just numbers on a spreadsheet. They are, quite literally, the arteries of the economy. I recall that source that spoke about the deep multi-generational history.
That's right. The anecdote of the grandfather, the one who arrived as an undocumented immigrant, found work with Canadian Pacific near Lambton Yard, and spent 50 years working the rail to eventually earn his citizenship. That story really reinforces that rail infrastructure is far more than just a cyclical stock. It's a structural part of North American economic history, community identity. When we talk about CNR's performance, we're really talking about the integrity of that structural backbone.
Exactly. And that integrity leaves us with this fascinating high-stakes conflict for investors. On one hand, you have an essential, resilient duopoly business structure with an unrivaled geographic moat, proven operational excellence through PSR, but it's simultaneously weighed down by a significant $10 billion debt load, potentially fueled by past financial engineering, all while operating under severe, immediate macro pressure from tariffs and a strengthening FX rate.
That perfectly summarizes the investment dilemma, doesn't it? Some analysts, probably relying on that valuation model that sees the debt as problematic and the sustaining Capex as a true cost, they suggest that the current dividend yield, around 2.73%, is simply not enough compensation for the leverage risk, especially if that feared recession hits and the benefits of the debt maybe revert dramatically.
Right. Whereas the structural bulls, they tend to look past the temporary market fluctuations and maybe even forgive the past debt strategy. They see the current, somewhat discounted trading price as a temporary opportunity. They're betting that the company's operational mastery and that unique strategic geographic advantage, that single-line connection to 3 coasts, will ultimately ensure the expected 10% future earnings growth eventually materializes. They believe it can overcome the short-term macro noise and the past financial maneuvers. #AuTuttiroCo.
Well, that was an incredible journey, really navigating the rough track of Canadian National Railway. We've seen a company that faced severe sort of one-off operational issues back in 2024, but then quickly executed a pretty aggressive pivot. They leveraged cost takeout measures, PSR discipline, including lowering headcount, improving fuel efficiency to maintain positive adjusted earnings growth in Q2 2025. And they did this even as they battled these escalating pressures from global tariffs and an unfavorable strengthening Canadian dollar.
Yeah, the ultimate takeaway for you, the listener, is really understanding how to correctly judge value in an industry like rail, essential, cyclical, and often highly leveraged. You have to ask yourself, is the consistent reduction in shares via the buyback program a sign of true return on capital, reflecting superior PSR gains and efficiency? Or is the story fundamentally defined by that doubling of long-term debt over the last few years, potentially setting the stage for pain if interest rates stay high or a serious recession materializes? Which narrative holds more weight?
And that leads us perfectly to our final provocative thought for you to consider today. Considering that skeptical viewpoint calculates CNR's real PE at maybe 27, factoring in mandatory sustaining capital expenditures and the risk of debt reversion and a severe downturn, and knowing that the company just pulled its long-term guidance due to global uncertainty, which factor do you think poses the greater long-term threat to CNR's stock performance? The volatile global trade environment and those external tariff risks, or the internal long-term strategy of financial leverage that they've pursued?